Go to any investing seminar, read any book, and hear the common message. Property investing is about buy and hold, as this is where you can get the best possible growth. Being able to hold a property portfolio for the longest possible time will indeed deliver the best returns, smoothing out short-term fluctuations and setting you up for a more comfortable retirement. But what of shorter time frames? Is it worth considering entering the market if your investing time frame is any less than, say, 10 years? Let's take a look at 3 separate time periods and consider whether a property can indeed perform and deliver any sort of return in these periods. 1 to 3 years. An investment into property carries considerable expense. The initial costs of buying property can run to around 5 to 6% of the purchase price. These costs include stamp duties, legal costs and bank fees, and essentially add to your original buy price. While you can get a tax deduction when you sell, which comes in the form of a discount to the cost base for calculating capital gains tax, it still must be paid up front, and it carries the lost opportunity of investing the money elsewhere. In addition to this, while it's highly possible to get a positive cash flow from day one, especially during these times of low interest rates, many properties may not become positive cash flow for up to 2 years or more after the purchase. In that case, the average property may cost around $50 a week after tax, which will add $2,500 a year to your input into the investment, plus the opportunity cost. Lastly, you'll have both selling costs and capital gains tax when you exit. These will further reduce your gain. Let's consider an example. A property is purchased at $300,000. The loan is $240,000. The cash input is $60,000 plus $15,000 in stamp duty and costs. The total input is $75,000 and the total cost of the investment is $315,000. Assuming a 7% growth per annum, which remember is calculated on the purchase value or the purchase price of the property, not the investment costs, after 1 year the property sells at $321,000. There's $9,000 in sales costs, which is agents' fees and legal. The funds received by the investor is $312,000. The debt to repay is $240,000 and the cash in hand is $72,000. There'll be no capital gains tax since the adjusted cost base and sale price means that no real gain was made. In fact, there'll be a capital loss, but this can be offset against future gains and so no immediate cash value. The investor has lost $3,000 plus the $2,500 in holding costs. Add the opportunity cost of not investing elsewhere at, say, a possible 5% return, and the actual loss is $9,250. Let's consider selling after 2 years. The sale price is now $343,500, the sale costs are $9,500, and the funds received are $334,000. The debt to repay is still $240,000, and cash in hand is now $94,000. Capital gains tax on the adjusted cost base will be levied on the gain of $19,000. Now this is halved to $9,500, and at the 30% tax rate it'll be $2,850 for a final net gain of $16,150. After holding costs of $5,000 and the opportunity costs of $7,500 for not investing the original cash amount elsewhere, this investor will see a net gain of $3,650. Let's look at year 3. Sale price is $367,500 and the costs are $10,000. The funds received are $357,500, the debt to repay is $240,000, and the investor has cash in hand of $117,500. Capital gains tax on the adjusted cost base will be levied on a gain of $42,000. This is halved to $21,000, and at the 30% tax rate it'll be $6,300 for a gain of $35,700. After holding costs of $7,500 and opportunity costs of $11,250, the investor will see a net gain of $16,950. Now this is a return on equity of 22.6% after considering the opportunity costs, or 37.6% before those opportunity costs. Now from these examples it can be seen that given average growth rates and a cash input from the investor, 3 years is the minimum hold period to begin seeing a real return on property as an investment. In the event that the investor uses pure property equity to leverage against, then the first 2 years still don't return any benefit since there's no true gain, and the 3rd year becomes fairly profitable. In any event, flipping a property can really only work well when there's been some exceptional gain, or another strategy, such as renovating, has considerably boosted the achievable sales price. The longer you can hold a property, the better overall return it can produce. Hi there, I'm Margaret Lomas. You probably would love to buy an investment property, but you're so busy making a living and looking after the family that there's just no time to do so. Well, you're the reason that we created Property Match. The Property Match algorithm uses your investing criteria, myriad data points for thousands of suburbs across Australia, and machine learning to search Australia-wide and find the property which best matches you. Give us a call today or visit our website mypropertymatch.com.au to find out more.